price of gold keeps going up, but why? And more importantly, after recently surging above $5,500 an ounce and then experiencing one of the biggest single-day crashes in history, is it too late to buy? So, in today's video, I'm going to answer those two critical questions using the most recent data from the start of 2026. Let's begin with the immediate driver, inflation. Gold gets labeled an inflation hedge so often that it's become shorthand, but that framing misses what's actually happening now. By December 2025, U.S. CPI inflation had cooled to around 2.7% year over year. That's a very different setup than 2021 to 2022. Inflation is still uncomfortable, but it's no longer out of control. And yet gold just delivered one of its strongest years in decades. So what's really driving it? It's not about the price of eggs or gas. It's about confidence in money. Even with a new administration and policy changes, the big picture hasn't shifted much. The U.S. is still running massive deficits, and the Fed is still stuck supporting the system by quietly creating more dollars. When more money keeps getting created and gold's supply stays limited, the math starts to matter. Over time, people realize their currency is slowly being watered down. That's the key point. Gold doesn't need inflation to be high. It needs people to believe money is getting weaker or that the system behind it is less stable. Sometimes inflation proves that. Other times it's debt, politics, reserve policy, or a mix of all of it. If you think gold only rises when inflation is high, you're misunderstanding the full market cycle. To understand why gold is at $5,500 and not $2,500, you have to look at interest rates. As of January 2026, the Fed is holding the funds rate around 3.5% to 3.75%. On paper, that sounds okay, but look at the real world. With the new tariff regimes and supply chain shifts we've seen over the last year, sticky inflation is running closer to 5% or 6% in many sectors. If your high-yield savings account or your treasury notes are paying you 3.7%, but the cost of living is rising at 6%, you are losing nearly 2.5% of your wealth every single year just by doing nothing. That is a negative real interest rate. You're being eaten alive by the very system that's supposed to protect your savings. Historically, this is where gold shines. When real returns are weak, the downside of holding gold disappears. It doesn't pay interest, but at least it isn't slowly being eroded. What makes this cycle different is that some real yields have actually been positive, yet gold still surged. That's unusual. It tells you this isn't just an inflation or interest rate trade. It's a trust trade. Even when investors can earn a real yield on paper, many still prefer gold. Why? Because gold doesn't depend on a central bank, a policy meeting, or a sudden decision that changes the value of your savings overnight. And that's before you factor in two big forces pushing demand even higher: aggressive central bank buying and growing concerns about fiscal credibility and reserve risk. Let's talk about those. Now, I want to talk to you about something bigger than just your local bank account. I'm talking about the central banks. In 2025, central banks bought over 1,100 tons of gold, the largest sustained buying spree in over 70 years. And when central banks buy gold, the motivation is different from yours. They're not trying to beat the S&P 500 this year. They're trying to answer a national-level question. What asset can we hold that is no one else's liability? That phrase matters. A treasury bond is a promise. A bank deposit is a promise. Gold is not. Remember back in 2022 when Russia's reserves were frozen? That moment was a wake-up call for reserve managers around the world. Since then, countries, especially across the BRICS bloc, now led by India, have been steadily diversifying away from the dollar. In the last 2 years, we've seen the dollar's share of global reserves drop from nearly 60% down to roughly 56%. Think about that. If you're a country that isn't fully aligned with U.S. policy, why would you keep the bulk of your national savings in a currency that can be restricted or frozen overnight? You wouldn't. You'd look for something neutral, something no one can turn off, so they buy gold. Even though central bank purchases have slowed slightly from their absolute peak, they remain historically high, and more importantly, they can continue for a long time. These reallocations don't happen all at once. They happen slowly, year after year. That steady shift from paper promises to hard assets is a big reason gold's momentum hasn't gone away. Now we get to the uncomfortable part. In 2022, the world was reminded that reserves aren't just numbers on a spreadsheet. After Russia invaded Ukraine, a large share of its sovereign reserves held abroad, roughly $300 billion, depending on how you count, were frozen. Whatever you think about the politics of that decision, the financial lesson was simple. If your reserves live inside someone else's system, they can become political. And it's not just about freezes. Holding reserves inside someone else's system also means trusting their long-term fiscal discipline, their debt, deficits, and political incentives. And once that idea sinks in, the reaction is pretty logical. Countries that don't want to be vulnerable to Western financial infrastructure will naturally look for assets that can't be frozen or restricted the same way. That pushes you toward gold, because gold is harder to interfere with. So when people ask, why are central banks buying gold? Part of the answer is simple. They're trying to avoid being trapped inside someone else's financial infrastructure. I know what you're thinking. It's already up 26% in the first month of 2026. Doesn't that mean a crash has to be coming? That reaction makes sense, but history tells a different story. In the 1970s, bull market, gold rose about eightfold. In the 2000s, it climbed more than 7 times. If you applied that same long cycle math to the current starting point, prices like $8,000 or even $10,000 aren't wild guesses. They're well within historical precedent. We are currently in what analysts call Phase 3. Phase 1 was the physical surge. Phase 2 was the return of the Western ETF investors. And now, Phase 3 is the global debasement trade. This is where people realize that the $34 trillion U.S. debt, now climbing toward $40 trillion, isn't a problem for tomorrow. It's a reality for today. At debt levels like this, governments don't really have many options. The most common one is to let inflation do the work, to make the currency worth less, so the debt is easier to manage. Gold doesn't cause that process. It just reflects it. Now, I need you to lean in and listen closely, because this is where most people get hurt. Gold has real risks. Risk number 1, volatility. Gold doesn't move in straight lines. Even in long bull markets, it tends to surge, stall, pull back, and frustrate people along the way. Sharp drops don't mean the thesis is broken, but they do punish short-time horizons and impatience. Risk number 2, opportunity cost. Gold doesn't pay you to own it. No dividends, no cash flow. While gold was rising in 2025, stocks were still compounding. If real yields rise or markets stay calm longer than expected, gold can lag for years. Waiting for a big gold payoff can mean missing gains elsewhere. Risk number 3, narrative swings. Gold moves on stories, and those stories change constantly. It rallies on fear, falls when fear fades, then rallies again when fear returns. If you don't know why you own gold, insurance, a hedge, or a trade, you'll get shaken out by the first scary headline. Risk number 4, the wrong product. Not all gold exposure is equal. Some products carry high fees, poor liquidity, or hidden risks that don't show up until markets get stressed. If you own gold, keep it simple and make sure you understand exactly what you're holding. So, is it too late to buy gold? Here's the honest answer. It depends on why you're buying it. If you're trying to day trade gold for a quick win next week, then yes. After a sharp move higher, you should expect pullbacks. Markets don't move in straight lines, and short-term timing always matters. But if you're thinking in years, not days, the question changes. There are really only 2 sensible reasons to own gold. First, insurance. You don't buy insurance because you expect something to go wrong tomorrow. You buy it because the world is unpredictable. If gold plays that role in your portfolio, too late isn't the right question. Entry price matters far less than position size and purpose. Second, a macro trade. In this case, you're buying gold because you believe certain forces will continue to support it. Geopolitical tensions, central bank demand, currency debasement, and ongoing fiscal stress. And those forces aren't hypothetical. So here's a simple gut check before buying. Question 1. What is gold's job in your portfolio? If gold is insurance, you size it small and accept you might buy at highs sometimes. If gold is a trade, you need clear rules and risk limits. Question 2. What would break the gold thesis? A real break would mean central banks start selling gold, government finances improve for years, real yields stay high without instability, and trust in the system genuinely returns. Could that happen? Sure. Is that the world we're in today? The market is clearly saying no. Question 3. If you bought today and gold dropped 20%, would you panic? If the answer is yes, you're sized too big, or you're buying for the wrong reason. That's it. That's the whole game. Don't wait for the perfect entry. In a world where currencies are steadily losing value, the perfect price usually exists only in hindsight. The worst mistake isn't buying too late. It's buying for the wrong reason and selling at exactly the wrong time. But listen, gold is just one piece of the puzzle in this changing economy. If you want to understand the bigger picture of where we're headed in 2026, check out the 2 videos on your screen right now. I'll see you over there. Take care.